Hey, everybody, good afternoon. This is Doc Severson with 12-Minute Trading. I'm joined by Dave Lukas here. Today is Monday, the 22nd of January, and the rally continues. We saw a big breakout above 4,800 on the S&P last Friday. Today, we've seen a gap higher, but it's a little bit shaky today. So we're on a little bit tenuous turf right now, but we will get into what we see in the markets. Dave, what are you seeing out there today?
So we sat here last week and we talked about how we had these fully charged daily charts that were ready to break out in a direction, right? And it was interesting, we talked about, hey, 4,700 has to hold if we go down. Otherwise, if we break 4,700, that daily energy is going to keep going. Conversely, we said if we went the other way, it's probably all-time highs. And we said we'd know by the end of the week. And by the end of the week, the market did a great job with the bear trap, right? It went down to 47.14 by Wednesday, and now we're all the way up from 47.14 to 48.50 in just 3 days, right? So what a bear trap that things are into. Now, at this point, we've got the energy is getting depleted very fast after this move. So we're already at like 45 on the daily, and the Nasdaq led the way. If you noticed last week, the Nasdaq really kicked it into gear and started it, and it was really noticeable by Friday. And then today it's having a little bit more trouble, and part of that reason is Doc will show on the charts here in a little bit is the fact that we've got some exhaustion coming in the daily chart already on the NDX and on both of these charts, the SPX, the NDX, the Dow, even too. The only exception being the rut is that we're outside the upper Bollinger Bands, and typically when we're outside the upper Bollinger Bands, you kind of get thrown back in, right? We always say they kind of act like the ropes of a boxing ring, right? They bend, they don't break. The boxer hits up against them, gets thrown back in the ring, right? So we're at that point where we've hit up against them, and we're probably going to get thrown in. And then we can keep going again. It just, that typically is what we'll see. So I would expect to see, maybe some selling over the next couple of days, maybe a retest of 4,800 on the SPX just to go back and retest that breakout zone. And then, if that holds, then I think we turn around and we can continue and maybe have to walk sideways a little bit while we get the daily charged up again, because the weekly is incredibly exhausted across the board right now. So it's got to be the only thing is the daily that can really keep it going. But my prediction, and Doc, I know you think a little bit differently. We were just talking about this, and I can't wait for you to share what you were telling me a minute ago. My prediction is that I still think over the next 6-8 weeks, February into March, that we get a correction, and an 8 to 10% correction that sets the floor for the rest of the year, and then it's just steady straight up, from there for the rest of the year. That's still my prediction. We'll get that one move where, oh no, we're going back again. It was all fake, and we hit all-time highs, and that was it, and that's the high for the year, and then cements that higher low, and then right up from there. So, Doc, though, you've got a different theory. You don't think that has to happen. So, tell me what you were telling me before we got on today.
Well, I guess I was thinking the other day, like how negative everybody is about just, geopolitics and U.S. politics and the market and the fact that the Fed has raised rates and the housing. I mean, you can come up with a million excuses as to why we should be at lower prices. And quite honestly, we get, every time we put out a YouTube video, we get the comment section lighting up, saying, well, anybody could see that the price should be lower from here. How dare you suggest that the prices should be able to, stay at these levels? And frankly, quite honestly, I don't care which way it goes. I mean, we're pretty agnostic when it comes to price. But what I'm seeing in the market these days is what's called a cup pattern. It's a rounded base. It's a cup pattern. Now, as to whether or not we're going to get that cup with handle that Dave talked about, or we're going to get, just some type of a, 3 to 5% haircut along the way to set up this sort of base, and that would actually allow the weekly chart. So that it makes a ton of sense for a correction to show up at this point, or some type. We already got our correction out of the way for at the end of 2023. So I don't know if we need a full correction, but at least some type of corrective behavior to set up the trap for things to go. So there's a question as to whether or not we're going to get this or not, or whether the price is just going to run. But man, if you look at how the price has been acting lately, this is why I'm considering going back to a 9 period, because it doesn't make sense what's happening right now on a standard 14. So with that in mind, if you think about this though, whether or not if we have a rounded base here in the monthly chart, irrespective of whether we get the handle or not, I don't care. The way that you read these things is the measured move target is the depth of the base. And we're going from 3,500, which is October of 2022. That was the bottom there on that bad CPI print that we got, which reversed on that day, up to 4,800. And if my math is right, I think my math is right, that's something like a 1,300 point move. So you tack that on to there, and we're looking at 6,100 on the S&P. So let me see what the math is from here. That would be, if we do a 1,300 point move on top of
30%,
4,800, that is a 27% move on top of here, which would be, a pretty good year. So could we potentially see, and I'm not calling it, I'm not predicting this, but I'm just saying this is a possibility. Open your minds to this possibility, irrespective of all the crap that's going on out there, irrespective of the politics of the Fed, all the other negatives that are out there. Right now, the market is saying, hey, there's a potential for 6,100 sitting on the table. And imagine if you were positioned correctly for that move, right? So imagine if you had everything set perfectly for that move, which nobody ever does. Nobody ever predicts the future perfectly, right? But if you had just a small portion of your capital set up to take advantage of that, based on a trigger, maybe you start to see the price breaking above 4,900 and you say, okay, green light, I'm going to do it. Or maybe on some type of pullback during the correction or something like that. But maybe, there's lots of different ways to set up sort of, kind of a time bomb type of trap trade that's up there. You sell an out of the money debit vertical with just some outrageous reward to risk. I mean, you could probably set up literally hundreds of contracts up there for a very, very low fee at today's volatilities. We have low volatility, but give yourself enough time for that move. I've done these in the past before, like if I were to get bullish, and those were usually times when the price was going really well. They did not work out for me, but it was like I had to do it. I had to do it just in case. Be kicking myself if I didn't have that set up. So anyway, that's that is my read on things right now, is that we have a 1,300 point base. That's pretty amazing. And however it gets there, we do have a measure move target at 6,100.
There's another way to look at that too, and it's something that I typically have done in bull markets in the past. And this is a little different. This is you got to have capital for this. I'll say that much. But one of the things that I've always liked to do is when we start to get in these bull runs, I ask the question, and I'll ask the question of all of you, Doc, too. Do you think that we will be at today's price at the end of the year or higher, based on what we know? And I would have to say that we're going to be at a higher price than where we are today by the end of the year. I still might predict we're going to get a correction over the next 2 months. Something will be the catalyst for us. Maybe it's the Fed in 2 weeks. Maybe the Fed comes out and is more hawkish than it was in December, and that causes markets to sell off some. And we go through a corrective move into the end of February or mid-February and then into March. But at that point, like I said, I think we'll find a nice base, nice higher low, and take off from there. So I always ask that question, are we going to be higher, a year from now? And the trade is simply to sell an at-the-money put or put spread on the index and let it go for a year. sell out to December, sell out to January of next year. It's what we would call more of like a low probability, right? So you're not gonna risk as much, right? So if you're doing like a 5 wide, even, you're probably gonna get paid $2.50, $3 for it. So your risk is $2, right? You're like 50-50. But if you just let it go, and time has to eat away at that for a while, but as that market does go up over time, that begins to profit. And it's like a CD. It's like putting a CD in place for a year. And if you do it well, you can make 40-50% on your money, doing that. And so that's another way to kind of look at it. And it's, the risk is, like 50-50 on those typically. But if you really think, hey, we're going to be higher at the end of the year, I tend to do this once a month. I take a small amount of capital. It's kind of like my asymmetric risk reward capital that I set aside, to risk heavier on. And, I do, the amount of contracts that I've got. And I just do it like every month and average into a certain point to where I think, okay, I don't want to go out any further than that because we could be turning by then. But as long as I look at it and say, a year from now, are we going to be higher? Are we going to be higher? And I can say, yeah, I really believe that. Then I'll set those up. And they work pretty well when we're in these bull markets like this. For the period before, the last bear, moving up, it was a side strategy that I did personally, and it worked really, really well. So just another way to think about it, another way to look at things that obviously don't require much management when you get in them. You just let them go and, give it the time. So, but you're in it for a long time. So that's another way to look at it.
I'll tell you what, I'm going to show you guys something that I like to do. What I'm going to do is I'm going to pick on the SSO here, and let's set up a crazy trade. And the way that we're going to do this is what I call a modified synthetic long. Some people call them risk reversals, but let's start off like what Dave talked about. So what I'm going to do is I'm just going to do this in the analyzer, and I draw you guys a picture. Let's go out to something crazy. So right now we're in January 2024. Let's go out to January 2025. Okay. And so first of all, let's look at the SSO on a single price chart.
And you guys all know what the SSO is. It's basically the S&P 500.
It's the S&P. It's a cheap version of it. And it's one that I don't mind being assigned if I get there. So what I'm going to look at is I'm going to say, all right, I don't mind if I'm assigned at 50 or 55, somewhere down in this area. It's below the 200-day moving average. That's great. So what I'm going to do is I'm going to go out a year from now, and I'm going to look at some of these, say 50 or 55. All right, so let's take a big fat credit here at 55. So let's be aggressive. And what I'm going to do is I'm going to sell a put. So what is the capital required to sell that one put right there at 55? Well, it's going to be 5,500, right? Because I have to have the capital to be able to buy the stock in case I need it. So right now the capital required for this is 5,500. So this is not a big account that we need. This is a medium size account is all that's necessary for that. So I'm going to pull in $300 of credit for this. So I'm going to lock that in. Let's assume we get three. Actually, let's split the difference. Let's see if we can get, say, maybe 310. We'll get a $310 credit for this. Now I've got a budget. And what I'm going to do is I'm going to go straight over here to the calls. And I've got a $310 budget to go buy some calls. And this is perfect out here, the 18 Jan 80s. And so what I'm going to do is I'm going to buy a single out here. Okay, and we're going to be spending, let's say, $250, $255 for that. So we're going to split the difference, maybe $255. Okay, so again, what we've done is we've sold a put to generate the income, basically to finance the trade buying calls. So this is a trade that I would use if I think that there's a big potential for something big to happen in the future. There's no way we're going to time it perfectly. Right, so this is a classic case of time in the market beats timing the market, right? So how does this thing look? Now, this is what I love. Here's where the current price is here. Here's where the current price is. For me to get into a loss condition, price has to drop all the way to 55. I'm willing for, if the worst that happens is I end up owning SSO, owning the S&P 500 at $55 a share, so be it. I'm fine with that. I'm willing to bet on the S&P 500. But if I think that there's a possibility for, if we go out to the chart, and again, we get that same type of move here, we're going to get, say, like a 35-point move. So this thing would be maybe 110 by the time it's done, right? So look at this. I mean, all of a sudden now, if I get the price to come up to 110, I'm potentially earning $3,000 on something like this for doing nothing and having literally no risk. Now, the risk of, say it doesn't take off, say it doesn't go anywhere, it just goes sideways for the next year. What's my risk? My risk is $55 credit. There is no risk unless this goes below 55. So this is one of my favorite trades for the investor that can't watch this stuff every day, that just wants to have something set up in case there just happens to stumble into a trend. Now, what's the difference between this and owning 100 shares of stock? You have that unlimited risk of owning, stock. A stock is, you have unlimited risk to zero to the downside, right? So you're going to take those losses if this thing doesn't take off. But this is what I love about this strategy is you've got this big, fat area in the middle where you can't lose. You can't lose. And if you time it right, or if you happen to get into a big move, you're long and strong, and you've got a whole year for this to work out. So anyway, that's what I call the modified synthetic long. And we've used that before several times, and I intend to use it again this year. If we can get a pullback, if we can get a little correction or pullback, that's the perfect time to set these up because it jacks up your put options. It gives you more budget to work with. It allows you to play the calls closer because you have more budget to work with.
Yep.
So I like that.
Yeah, I'll tell you, if we do get an 8 to 10%, I've got a lot of capital I've been setting aside, just getting ready to put to work, and either something like that, if it doesn't come, or if we do, and I will go very aggressive into any correction that we get at this point and sell into that and sell a lot tighter, closer to the money than I normally would into that. Because I just think that the way here's my prediction for the year, right? So we get this small correction over the next 2 months, maybe 8 to 10%. Then we get into the spring, we start to grind a little bit. We get into summer, we get another parabolic move like we've just seen, as we usually do during the summer. September, October, we get some corrective action, the typical volatility. The election happens. It provides certainty to the market. No matter who's elected, it's certainty. And then you run straight up in the end of the year. I just think that's how we do it. And I think you're going to see, I think S&P ends the year somewhere between 5,200, 5,400 range. I think that's where the S&P ultimately gets to by the end of the year. But I think a lot of those gains are going to come in the back half of the year. I think we might even shoot up there now to 5,000, and then that's where we sell off from, and then we and then we get going again, right? So
I might as well go for the over. I'll go for 6,100 then,
because
somebody's got to do it.
So
hey, we got a question coming in from.
I like to look at the macro picture too, and there's a lot of things in the macro picture that are ugly. So. I've never seen the Fed actually succeed with these things. In all the history, I've never seen the Fed have a soft landing ever. They either way late to the party, or they stay way too long, and they always screw it up. Their track record is horrible.
Did I hear the other day, and I don't follow this very closely, but did I hear the other day correctly that the yield curve is now uninverted?
Last I saw, it was getting closer, but it's not uninverted yet.
Okay.
The 2 and the 10.
Because they always talk about the yield curve being inverted, like guaranteeing a recession, which is why everybody's been so bearish for the last couple of years. And if we're able to escape that without falling into recession, that maybe the only thing that could make the difference, and it isn't good, is the massive government spending. That's the only thing that's offset it. That's really what's made all the difference. That's why we've got 34 going on 35 trillion in debt. And that's your problem, in the sense that
not a problem so much, but that's what's kept us from really going over the cliff. But a lot of that spending has stopped. The COVID stimulus money, that's all gone, right? We're in an election year. So, and everybody's, cares about that stuff. So now all of a sudden, hey, it's amazing. All of a sudden, the other party cares about border security now. You know what I mean? Like, so it's the election year. So you start to see like, okay, we're not going to spend as much. We're not going to, you know what I mean? And so that all comes into play. One thing I didn't know, and I saw this I was reading a thing the other day. Do you know the average time that it takes for the impact of Fed rate hikes when they actually finally are seen in the economy?
About probably 18 months, I would say.
10 quarters.
Wow. That's 2.5 years.
10 quarters. Yeah. Yeah. I was surprised that that's the average in history, 10 quarters. So we haven't hit, that we're close to that point where, we actually start to see the actually impacts from Fed rate hikes.
Yeah. I mean, I agree with you because I've never once in my lifetime seen the Fed preemptively start to trim rates on a proactive basis. They always hold on to that. It's like, it's like the little kid that you couldn't play with his toys because he just wanted to hold on to them. It's like, it's my toy. You can't have it.
Yeah, and when it comes to the markets too, I mean, if they start aggressively cutting, then it means something else to the markets. The market's like, what's up here? What am I missing? And that's why you usually see markets sell off when the Fed actually does start to cut rates. So history is not in favor of a soft landing.
What do they know that we don't know? So I got a question coming in from the Chalupa man here. Hi, Doc. What makes you think 14 candles are insufficient for the current market? Didn't you say that the 9 is better for a choppy market while the 14 is better when grinding upwards? Yes, correct. I did say that. And that's what I've been talking about for the last couple of months, though. I went over to 14 as we got into the new year. And now I'm starting to doubt that decision because the problem is, and Chalupa man, the reason why I went over to 9 during this time frame here was because the market didn't make any sense. Look at this. The market does not make any sense. It's not operating fast enough at 14 to figure this out. Now, what I'm also seeing is it doesn't make any sense that we're below 25 on an energy level and we're still continuing to break higher. That doesn't make any sense to me. So unless we see an overthrow here in the next couple of days, which, could be bad if we see one, because that's going to cause a bull trap and probably send us down to somewhere in the 4,600s here. But unless I see that, I may be forced to stay back with 9 again, because does 9 make more sense? Again, it's not like we can just go ask the market and say, hey, what speed do you want? What we have to do is we have to find out what makes sense right now. And if 9 makes more sense, we're going to know, I think, within a week or two as to whether or not. But right now, this was way too short. This was way too short a consolidation to support 14. So if the market's now operating faster, if we're going to get shorter consolidations to recharge the chart, and then take off again. If we're going to go more vertical, then we have to go faster. And so that's what I'm proposing, is that I may have to go back to 9. I don't know yet. And
pull up the 14 again, though, to show everybody where that chart is on the weekly, because that is the most exhausted I've seen in 5 years. So the most exhausted level ever on a 5-year weekly if you pull up the 14.
So, yeah, if you go back, all through this time.
Now, look at that.
Actually, we're at a very similar level to right before the pandemic. We were.
Yeah, look at what happened.
Well,
so again.
All right, that's an exogenous event, but it was set up.
Yeah, I mean, things never look. Things aren't the same, but they rhyme, right? So they're just like. Again, historically, there is a good case to be made that we're going to see something coming up here.
Now,
Whether it's 9 or 14, like if you pull up the 9 and look at that from the 9, it'll probably look like today's looked.
I want
So
to show
it's
you.
just,
I want to show you something that we live and die these things through these things, and this reminds me a lot of, if you look at this move here. So back here,
yeah,
this is in 2007, I believe. This is the summer of 2007. Rally, chunk, we break out, and then what happens? We fall back down in. And in fact, we didn't just fall back down in, we actually went into a full correction. So
right.
this is your classic throw over. Imagine this is like a clothesline, and you're throwing over a towel or something like that. This is a classic throw over. And this is the one, current one is what reminds me of this, actually. So unless we get some traction on here, unless we see a good consolidation, which, and I don't care, like intraday, an intraday test of 4,800 would be like ideal for this. That would generate enough bearishness to probably get this to be able to break higher again, irrespective of what's happening in the weekly chart. But my concern is if we see a close below 4,800, that would be extremely bearish in this environment, and we would probably be sitting there looking at somewhere at this level or lower for the eventual result.
And there's that gap. There's that gap from the breakout right there too. I mean, it's glaring.
Yeah, it's pretty small. It's a pretty small breakout.
It's easy to fill. It's easy to go back and fill, but you can fill that intraday and go back above 4,800.
Are you talking about this one here?
No, I'm talking about the gap right around 4,800 from 2 days ago.
Oh, this one.
That's the big one down there.
This one almost got filled. Again, that's actually, let's go to the gap chart. The gap chart is authoritative here because we almost got. So there's your gap. It's actually pretty small, but it's there. But the market has not been caring about upside gaps to this level. The market has been destroying any downside gaps. So that's giving us a sense of character for what's going on. So any other questions out there before we wrap up for today? Any other questions today?
I will say I'm still on the 14-day. I actually held the 14-day all the way through. And learned a lot looking at it versus the 9. I jumped back and forth, but I still traded off the 14-day and was successful with it. And now it's, even better, but I think you're right. I mean, we'll see if it keeps just, having these massive kind of spikes higher. If it does, then the 9 days is a better one for that.
Yeah. We'll have to see. We'll have to see. So this should be an interesting week. This is going to be a quiet week for the first 3 days, and then Thursday we got a ton of stuff going on, as well as some of the tech stocks are going to be reporting by the end of this week, and then Friday we got PCE, which is going to be important as well too. And then next week
Tesla this week.
Yeah, so we got Netflix and Tesla, we got IBM, I think, we got Visa, we got some really important. We have some big industrials this week, so this week's huge for earnings, but next week is even more bigger. So
that's the week.
It's bigger. So next week is we have the Fed and we have most of the tech giants as well too. So minus NVIDIA. All right, everybody. Thank you very much for joining us today, especially for those of you watching us on the replay. Let us know if there's anything that we can do in a future session for you guys. Thank you, everybody, for joining us today. And don't forget, Dave and I have got a little soiree coming up on Thursday. Dave, let them know about it.
Yeah, definitely. Annual year-end review event. So that we do this every year. We go through the lessons learned. We talk about like strategy changes we're doing, implement new strategies that we're doing in the marketplace, as well as some other big announcements and stuff that we do. We always kind of, get ready, put everything together for this event, and then kind of announce it all out and stuff. And so we've got some pretty darn big stuff for this week. So definitely make sure you can attend. I think the link is in below here, so you can grab the link to register. It's Zoom. But got some new, I'll tell you right now, new strategies being released, a couple other big announcements. This is not something that you want to miss. So make sure you tune in.
All right. Thanks, everybody. We will see you guys, and we'll see you Thursday. See you Thursday night. Thanks, everybody. Take care.